Okay, thank you all. And I have to say, I thought that was a terrific panel, so congratulations to David and all of the panelists. And so it gives us a bit of a high hurdle here for the second panel. What we're going to be focused on in panel 2 is that while there's broad agreement that we need the Fed or other central banks as lender of last resort, I think there's also quite broad agreement we don't want the lender of last resort function to be used all that often. And therefore, we need to make sure that banks and perhaps other important financial institutions maintain sufficient liquidity. And so this panel will focus on the rules intended to ensure that there is adequate liquidity at the banks. So we have a great panel of experts to explain and debate these issues. You have bios in each of your packets, so I'm going to only very briefly introduce each one. After I walk through a few introductory slides, because there is a chance some of you don't actually already know these rules, though it's a pretty knowledgeable crowd, I will say, from people I know here. So I'll go through a few introductory slides, and then we'll start with Mark Vanderweide. He's a Deputy Director in the Division of Banking Supervision and Regulation at the Fed. He'll be followed by Mark Seidenberg, who's a Principal in Ernst & Young's Financial Services Office, and he was previously at the Fed for 15 years. Paul Ackerman will follow. He's Treasurer of Wells Fargo, a small bank you may have heard of. And finally, we'll end with Adam Gilbert, who is a Managing Director at JP Morgan, who focuses on regulatory policy. And thank you to each of the panelists for joining us. So I'm going to just briefly introduce the topic, and then after I finish, we'll bring the panelists up on the stage and have them go through one by one from the podium. So I think it's pretty clear at this point, particularly after the financial crisis, that liquidity does matter. Banks have always been vulnerable to runs because they make multi-year loans which are illiquid, and they do it using deposit funding. And we've had, as banks have expanded their activities and as non-banks have joined in to similar types of activities, it's expanded beyond just that narrow issue, but you still have long-term loans or other important assets funded by short-term funding. So lender of last resort function is intended to protect against runs like that, but we do want banks to handle most of the liquidity needs by themselves because we don't want the lender of last resort function being called on very much, and we want to reduce the problems that are caused by fire sales prior to the lender of last resort stepping in. It's also clear that banks were too illiquid prior to the last financial crisis. Liquidity regulation was really pretty loose, and there was no equivalent of the Basel capital standards, which created more quantitative, globally agreed standards. Liquidity seemed abundant, and it felt like it would always be abundant, that there had been a sea change from earlier years. And banks, therefore, you can argue reasonably sensibly, decided not to increase their expenses in order to improve their liquidity. Because liquidity does cost money. You either give up some investment income by shortening your assets, or you pay more for your liabilities in order to get longer-term liabilities, since there's usually a yield curve where longer-term assets and liabilities have higher yields than short-term ones. So to deal with the illiquidity problems that we have observed, certain new liquidity rules are being put in place. And they've been foreshadowed a bit in the first panel, but I just wanted to touch on them for those of you who haven't followed this as closely. There's a liquidity coverage ratio, or LCR, which is part of the Basel III agreement. That's the global agreement on capital and liquidity standards. And that will be effective as of 2015. There's also something called a net stable funding ratio, and I'll tell you more about these two. That's also part of Basel III and comes into effect in 2018. In addition, there are liquidity stress tests akin to the capital stress tests that we have now that the regulators are applying. And in general, there's going to be more careful liquidity supervision in addition to these quantitative tests. So the liquidity coverage ratio, as I view it, is a stylized stress test. You basically postulate a 30-day period of intense liquidity pressures in the financial markets. And then the quantitative formulas have you try to estimate whether banks would have enough cash to last through the 30 days. So you assume that on the one side, funding sources will dry up to some extent. So some of your deposits and even more of your wholesale funding will go away, and that the assets you were planning to sell to raise cash won't be worth as much in a crisis, so you'll have a haircut to their values. On the other side, we assume that there will be more needs for cash than in normal times. Your corporations will come and draw down on their credit lines, for example. And so the idea is you need to have at least 100% of the required funding in order to pass this. The net stable funding ratio is intended to tackle a somewhat different issue. So the LCR is this stylized stress test. It looks like an emergency situation. The NSFR is intended to deal with longer-term structural issues where maybe some banks have relied too much on short-term funding for their long-term assets and have created a situation in which problems could occur. So there you look at the available stable funding. So you essentially say things like deposits from retail customers are pretty stable, so you want to treat them as pretty valuable. On the other hand, some other sources are likely to go away to some extent, so you give them a lesser credit. And on the other side, you look at what portions of the credit lines might be drawn down. You look at haircuts on securities. So again, a little bit like the LCR, but it's trying to look on a longer-term basis for that. So those are LCR and NSFR are terms you're going to be hearing in this panel. And at this point, we can put the lights back up again, and let's bring up the panel members. And we'll go through one by one. So if you could all come up front. And I'll just ask that you each speak from the podium when it's your turn, starting with Mark Vanderwide.
Thanks, Doug, and thanks for the invitation to participate in the conference. I thought in my remarks today I would first offer some views on why liquidity regulation of banks makes good policy sense as a general matter, and then make some comments about the specific framework of bank liquidity regulation that the Fed and global regulators have developed in the wake of the financial crisis. I apologize at the outset to the extent that the first piece of my presentation treads on ground that might have been well trod in the first panel, but I find it hard not to start from first principles. Before I say any more, let me make clear that my remarks today are my own, and they may or may not be articulate, they may or may not be edifying, and they may or may not reflect the views of any governor of the Federal Reserve System. Let me start with the metaphysical question of why we need bank liquidity regulation. Following the hallowed traditions of microeconomic theory, I think this question roughly translates into, what is the market failure here that we're trying to solve? Or more specifically, why can't we rely on each bank to self-insure against its own liquidity risk? Or failing that, why can't we rely on interbank markets or on the private sector more broadly to provide needed liquidity to solvent but illiquid banks? As Governor Stein explained in an excellent speech on bank liquidity regulation last year, the business, and as Doug explained this morning, 5 minutes ago, the business of banking involves maturity transformation by definition, and therefore banks are inevitably exposed to various forms of run risk. In response to shocks, the relatively fragile funding structures of banks can result in rapid cash outflows that lead them to fire sale assets, to fail, or both. And fire sales and bank failures can have substantial negative effects on other financial firms and on the economy as a whole. So banks will naturally keep on hand some amount of liquid assets to deal with potential unanticipated cash outflows, but banks are unlikely to hold the socially optimal amount of liquid assets, because while they bear all the costs of holding those liquid assets in terms of reduced profitability, they do not capture all the social benefits in terms of enhanced financial stability and lower cost to taxpayers in the event of failure. It is also not clear that we should substantially rely on interbank markets, interbank funding markets to prevent or ameliorate bank runs. Most fundamentally, it seems imprudent for policymakers to assume that other banks will be willing and able to lend to a solvent but illiquid bank, that's under liquidity pressure. Information asymmetries are part of the problem. Healthy banks are often loath to increase their lending to a stressed bank because of its opacity. It's hard for a healthy bank to determine whether the stressed bank is solvent or illiquid or insolvent. A second problem is that the financial conditions of large banks are strongly correlated with each other and with the condition of the broader financial system. And this correlation has been increasing over the past decade as banks have gotten larger, more interstate within the US, more international, more interconnected with each other, and more internally diversified as the Glass-Steagall walls have come down. In other words, when one large bank is stressed, it is often the case that all or almost all other large banks are stressed. In part for these reasons, the interbank funding markets in 2007 and 2008 were not exactly a material source of strength for stressed banks. If you agree there's a market failure here, it seems you have two principal options for addressing this failure, simplifying a bit. The first option is central bank lending to solvent but illiquid banks. The second option is bank regulation. These options are not, of course, mutually exclusive. Central bank lender of last resort facilities should clearly be part of the solution. Some have argued that they might be the complete solution. According to this view, if you assume a well-functioning regulatory capital regime for banks, the central bank can always avert fire sales and bank failures ex post, simply by serving as a lender of last resort. But I believe there are good reasons to not rely exclusively on central bank lending to address bank illiquidity, and good reasons to think that social welfare can be increased by attempting to conserve on use of the lender of last resort. And I'll give 3 reasons why. First, we can't ignore the fact that there are legal limits in the United States on who can borrow from the Fed. Most notably, the Fed's firm-specific discount window is only available to depository institutions. It's not available to broker-dealers, to non-bank lenders, to asset-backed commercial paper conduits, to money market mutual funds, et cetera. And Section 23A of the Federal Reserve Act prevents the depository institutions from on-lending any of those credit from the Fed to affiliates. Second, viewed ex ante, the existence of central bank lender of last resort facilities creates, obviously, moral hazard, incenting banks to take on more risk than they otherwise would. Third, viewed ex post, central bank lending can create risks for taxpayers. Central banks are smart, but distinguishing an insolvent bank from an illiquid but solvent bank is challenging, particularly in a financial crisis. And as we saw in the crisis, insolvency is a leading cause of illiquidity, and illiquidity is often a leading indicator of insolvency. For all these reasons, I think that bank liquidity regulation is a good idea, and that the Basel III liquidity rules are an important part of the global regulatory reform program. The Basel liquidity rules for global banks do have and should have both microprudential and macroprudential purposes. The principal microprudential purpose of the LCR is to reduce the probability of a banking firm's liquidity insolvency over a 30-day time horizon through a self-insurance regime of holding enough high-quality liquid assets, HQLA, to meet short-term stressed funding needs. The principal microprudential purpose of the NSFR is to ensure that global banking firms have a stable funding profile over the longer 1-year time horizon. Another primarily microprudential purpose of the Basel III liquidity rules is to create a level global playing field across national jurisdictions. The Basel capital rules create a level global playing field for bank leverage. The Basel liquidity rules create a level global playing field for bank maturity transformation and liquidity risk. But the Basel III liquidity rules also help accomplish macroprudential goals, such as improving financial stability by reducing potential fire sale externalities and reducing the probability of SIFI failures. I thought I would move next to a brief discussion of the limits of the Basel III liquidity rules. Although these rules are critical to the financial stability efforts of global regulators, it's important to recognize that these rules do not ensure that there will never again be a liquidity failure of a large global financial institution. They should help make such a failure much less likely, but they can't reduce the run risk of a bank to zero. And it's important that we understand what these global rules don't address, and I have 8 things I wanted to mention. First, the rules only apply to internationally active banks. They don't apply to broker-dealers, to non-bank lenders, to asset-backed commercial paper conduits, to money market mutual funds, and other aspects of the shadow banking system. Second, the rules don't address maturity mismatch inside the LCR's 30-day window or between the LCR's 30-day line and the NSFR's 1-year line. Third, the rules require a global bank to have liquidity adequacy on a consolidated basis, but they don't ensure liquidity adequacy in each legal entity or branch of the firm. Fourth, the rules don't address potential currency mismatches. Fifth, the rules impose effectively no penalty on matched books of repos and other kinds of securities financing transactions. Sixth, the rules include in the definition of what counts as a high-quality liquid asset, HQLA, some assets of pretty limited liquidity, including covered bonds, municipal bonds, and private label mortgage-backed securities. Seventh, the transition path for the global rules, which were effectively born in 2010, is a fairly slow transition path. Under the international agreement, the LCR phases in from 2015 to 2019, and the NSFR becomes effective in 2018. And finally, the rules treat the stability of central bank lending rather favorably, given the Fed's current discount window policies. I list off all these limitations not to implicitly criticize the rules that Mark Seidenberg created, but rather to help remind us of what liquidity risks in the global financial system the Basel rules currently cover and what they don't cover. So what should be done about some of these limitations? The Fed and global regulators have a lot of work still in train in the liquidity risk mitigation space, and I thought I would just close by touching on a few strands of that work. First, the Basel Committee recently proposed some amendments to the NSFR. These amendments are fairly wide-ranging, but they include provisions that would address two of the limitations that I just mentioned. The proposal would require some amount of stable funding for certain short-term extensions of credit by banks to non-bank financial firms, thus introducing a meaningful regulatory charge on some forms of the securities financing transaction matched books. The proposal also would draw a 6-month maturity line for certain purposes, thus reducing somewhat the cliff effects from the LCR's 30-day line and the NSFR's 1-year line. Second, the Fed and the other U.S. banking agencies, in their proposed rule to implement the LCR in the United States, decided to go super equivalent to the Basel standards in a number of ways. The proposal accelerated the American LCR transition path so that the largest U.S. banking firms would have to be in compliance by 2017 instead of 2019. The acceleration reflected the substantial improvements in the liquidity position of U.S. banking firms and a regulatory desire to prevent any backsliding in the meantime. The proposal also excluded from the HQLA definition certain relatively illiquid assets that count as HQLA in the Basel standard, namely the ones I mentioned before, covered bonds, muni bonds, and private label MBS. Moreover, the proposal addressed maturity mismatches inside the 30-day window for the largest U.S. banks. And finally, the proposal did not permit U.S. banking firms to treat standard overnight discount window lending by the Fed as stable throughout the entire 30-day window of the LCR. The public comment period for the U.S. LCR NPR has ended, and staff is analyzing comments. Third, numerous Fed principals, including Chair Yellen and Governors Trullo and Stein, have indicated that addressing residual risks from short-term wholesale funding markets remain one of our principal unaccomplished financial reform goals. As Governor Trullo has indicated, the board is considering a variety of policy actions to address these risks. The policy actions include capital surcharges for SIFIs tied to their short-term wholesale funding usage, further changes to the capital or liquidity rules applicable to banking firms, and minimum margin requirements for securities financing transactions. Fourth, we need to admit that we can't intelligently regulate every liquidity risk faced by global banks. There remains, and always will remain, a critical role for firm-specific liquidity risk supervision. Supervision of bank liquidity risk can help fill in the understood gaps and weaknesses of the regulatory regime, and just as importantly, can help mitigate some of the idiosyncratic liquidity risks that individuals' firms face that no regulatory regime of general applicability can efficiently cover. In addition, supervision is our first line of monitoring and defense against attempts by banks to arbitrage around the new rules. Let me close by acknowledging that we need to recognize that the science of liquidity regulation is new. It's new to regulators, it's new to banks, it's new to the financial markets. As with any fledgling science, we are certain to go down a few unproductive paths as we move forward. We will have our Ptolemaic epicycles and our Lamarckian evolutionary cul-de-sacs along the way. We need to attend carefully to the impact of the new rules on banks, markets, and the economy, in good times and in stress times, and we need to be willing to change the rules in the face of new learning. Thanks again for the opportunity to participate.
Good morning. Thanks, Doug, and thank you to Brookings for inviting me to participate today. I frequently in this situation would start my comments by saying something about perspective as an insider. I no longer get credit for doing that anymore, notwithstanding Mark's comments. So I'll just say that I wanted to offer a couple of perspectives from an active participant in the development of liquidity regulation. I want to take just a minute to sort of look back, at least I think of it as looking back to the development of the LCR in particular, and what in some ways what we can and cannot infer from that, and then spend a couple of minutes sort of looking ahead. I was tempted to start my comments today as sort of in defense of the idiots, but I actually think Mark has done a really credible job of defending the idiots, and so we can continue that conversation later. I think it's... That was a compliment. That wasn't...
I wasn't sure. I'll go ahead.
Sorry. Just to be clear, that was intended to be a compliment to Mark, not anything. It should not have been inferred as something else. Being one of the former idiots, that was my point.
Yeah, I spent some self-flagellation.
Yes, so that was anyway. I think it's helpful to reflect on the objectives in the development of the liquidity regulation within the Basel Committee and outside. And I say objectives plural, not just because, as Doug and others pointed out, there are multiple objectives about reducing the risks of the externalities associated with the failure of a large systemically important institution, as well as the fire sale risks. But it won't surprise you all that when you get together representatives from 26 different jurisdictions by the time we were done, of over 45 agencies and other onlookers, that describing the single set of agreed upon objectives is a little bit challenging. I will say that trying to navigate that collectively, I think it's fair to say the Basel Committee, notwithstanding or inclusive of the observations that Mark had about the limits of the Basel Agreement, I think could sort of be seen as coalescing around a view that requiring firms to have ex-ante self-insurance, not for all risks, but risks up to a degree, without reliance on public sector support, for the reasons that have been described of mitigating the risks of failure, for the mitigating the spillovers associated with fire sale, is sort of where the committee coalesced. I think one of the challenges as I look back, though, in relation to the subject of the conference today, is that design has led some people to infer that the intent was to never have banks rely on access to specifically the discount window or more broadly public sector liquidity support. And that's where I think there's a giant leap from saying something about a policy design and ex-ante incentives, and then to describe the LCR as being a depiction of how different actors in the economy should behave conditional on a crisis. So again, I think the point that what I would like people to take away from this is that with respect to access to public sector support, and very much in relation to the first panel's discussion, I don't believe the liquidity regulations, even with their limited recognition or non-recognition of public sector support, should be seen as a statement of there is no role for public sector support, there is no role for discount window or the lender of last resort. It's a distinction that's drawn between the ex-ante incentives in terms of designing a public policy and then how you expect firms and the public sector to behave. So let me change gears a little and say, from my perspective, then looking ahead, so where are we? Clearly, as Mark outlined, efforts to address those two core objectives of the spillovers associated with the distress of a large systemically important institution and the fire sale risks still exist in terms of as policy objectives. The continued discussions around the net stable funding ratio and short-term wholesale funding more broadly are sort of focused on that. I think, though, what I would observe is that there's another current running through the policy debate, some of which came up this morning and some of which I think is acute if you get to spend time watching the Basel Committee and even the U.S. regulatory process, is there's a perspective on what are the trade-offs between, and sometimes it's characterized as complexity versus simplicity, other times it's characterized as risk sensitivity versus something else. I'm not sure what the other side of that is. So I choose to sort of split the proverbial descriptions and say there's a trade-off between trying to be risk sensitive and try to have something that is simple. And where one thinks you want to fall in that balance is very much dependent on a range of factors, including how well one thinks you can design a risk-sensitive framework, what you think the unintended and intended consequences of a risk-sensitive framework versus one that is simpler and may create unintended distortions in the markets. And we were talking last night, or even this morning, I'd say characterize Regulation is intended to distort markets, consistent with Mark's point. The question is, are you creating the intended distortions, or are you creating some of the unintended distortions? So having said that, I think there's a real challenge when it gets to liquidity regulation that funding markets, this is not rocket science or terribly innovative, funding markets tend to be very complicated and have a lot more activity going on in them than I think some of the simple policy tools would give them credit. So I think that the wave of simplicity, particularly within the Basel Committee but elsewhere, has led to an affinity for some of the simple solutions to addressing liquidity regulation, without, I think, the appreciation of how some of the simple solutions may have unintended consequences. They may have some of the intended consequences, but they will also be associated with some of the unintended consequences. So what's the response to that? Because what I just said is sort of true of almost any policy debate. And so I think one effort that's going on now that we, Ernst & Young, are involved in actually with the Clearinghouse and a number of institutions that are represented in the room today is trying to deepen the shared understanding of the activities that are going on within wholesale funding markets so that you can have an informed dialogue around the policy debate. I would characterize generally, if you're going to have a policy debate, broadly speaking, there's two views you could have. One is that you have participants who have different objectives. That's certainly possible, a possibility, or different views about how to solve for those objectives, for the differences of objectives. The other is there's a perception gap about to what degree you have addressed the objectives you've achieved. And so in that way, I think having efforts to deepen the understanding of the activities that are going on in a given market is a valuable one. The survey that we've been conducting and have shared the results with the Federal Reserve and others is an effort to enhance the data collection that is there and get an appreciation that the nature of the activity in wholesale funding markets is going to influence the types of risk that we described. So if you consider that the world is not, as some would characterize it, simply, the wholesale funding world is not simply made up of financing inventory and matchbook financing, and that's the end of the world. There are other activities that are being conducted, quite a few activities being conducted within wholesale funding markets, where if you can deepen your understanding of what those activities are, the nature of the risks of those activities in terms of their objectives, but then also how the risk has been mitigated. So the information, the data that are being collected relate to the business purpose, what's the nature of the type of activity, but then importantly also what's the nature of collateral that's being financed through different channels, what's the tenor of that collateral. And I think if we could get to a point where there's a shared understanding of the activity, then at least we could narrow the debate to we have a different view about what the objectives are. And that would be a better situation, I think, for all of us, rather than a fundamentally different idea of what is the world we face or how far have we gone. So let me stop there and turn it back to, I think, Adam.
Well, good morning. I'm happy to be here, and I'm a bit humbled. There's a lot of great minds in the room, and I'm sure I'm not one of them. I hope that with respect to liquidity policy, I can bring a little bit of a unique perspective to this discussion because I'm an active practitioner. If I asked for a show of hands of people in the room that have responsibility for a Fed account and knew how much was in it last night and knew how much is supposed to be in it tonight, my guess is mine might be the only one. So I think I bring that. The other perspective I might bring after listening to the panelists today, I guarantee not to use words that have more than 3 syllables, because as bankers, we just don't understand that. So first let me say that even though I'm from a bank and a GSIB at that, it might surprise you to understand that I'm a strong proponent of banks having an ample amount of liquidity. And I think this was informed by having a ringside seat and being responsible for managing the liquidity of Wachovia right during the height of the crisis, and from the day that we announced the merger with Wachovia. And it was simply astounding to see the amount of liquidity that was consumed in a short period of time, and astounding to see what we had to do to stop that. So I come with a healthy respect of runs. I even benefit lately by that respect. Even when we had the debt policy or the debt ceiling debates in the fall and in the spring, we had minor market disruptions, but it was really good to have a huge balance at the Federal Reserve. Maybe that's finally my internalization of Charlie's admonition that cash has some value. So I am a strong proponent of liquidity. But having said that, I think there are some things about liquidity regulation that we can do better, and I'm going to talk about several of those. First, I think there are some things that are proposed in the LCR that really need to be fixed, and I'm hopeful that in the revision that's going on now, we will address those. Second, we absolutely have to make conscious decisions to keep the process simple. And then finally, I think I would agree with Mark that we have not done a good cost-benefit analysis. There is a cost to having too high a stock of liquidity, and we have not explicitly considered the trade-offs. So let me say a bit about some of the current issues I see in the proposed LCR. I'm just going to focus on a couple. The first is a treatment of the way municipal deposits, collateralized municipal deposits, are handled that has the effect of requiring high-quality liquid assets to be held for the entire amount of the deposit, rendering it useless. The other part of that, another element of municipal finance is that municipal securities are assigned no liquidity value. Okay, so as a sector, then municipal finance, this creates strong disincentives for any bank to be in the business of financing municipalities. So I think that is one thing that has to be fixed, and it simply doesn't reflect the behavior of either the deposits or the assets during the crisis. And I'm probably wasting my breath on this next point, but I just have to say that the limitation on agency securities in HQLA is just not based on observed market data. And the limit really should be eliminated. So I think that through the clearinghouse and others, the industry's done a pretty good job of presenting a limited number of things that we think are important to be changed, and I'm sure Mark will be very attentive to each and every one of those. So my second point is that the administration of the LCR is becoming increasingly complex. And Mark, if I understood it correctly, described it as simple. As a practitioner, I might take a different view of that. Let me give you some examples of that. So every day, Wells Fargo has to submit 20,000 data elements on liquidity to the Federal Reserve. 20,000. There's a new requirement that we think is coming out in January that our estimate is that will increase by 4 to 5 times. Okay? That's a lot of data to be pushing through. And while some of the data elements absolutely need to be evaluated on a daily basis, big security settlement flows, things like that, there's a lot of things that really just don't need daily attention. I think another example is this is kind of the increasing complexity of the rules. So one test that we have to apply to determine operational deposits requires that we evaluate 8 separate criteria for each deposit and then try to quantify those. And while I think you could argue that there's intellectual correctness to all those criteria, at the end of the day, it's important to realize that we're trying to estimate customer behavior. And that's always going to contain some degree of imprecision. So I think there's a false precision that we're trying to apply in the rules. And my point of this is not that I object to the work or the cost. It's that this process is growing increasingly complex without any certainty that the complexity increases its efficacy. And I think from my experience, I'm inclined to argue just the opposite, that when there's the presence of a lot of complexity, efficacy is actually decreased. And then my final point is that from an outside perspective, as regulations like this are written, you can see that when the authors are faced with a decision to make a balanced choice or perhaps a conservative choice, it's easy to take the conservative choice. I understand that. But what I think is not explicitly considered in this process is the cumulative effect of all these decisions. So the LCR has a number of things that are a number of conservative choices that are pretty easy to identify. The assumption that all outflows occur on day one. Limitations, arbitrary limitations on the amount of contractual inflows that can be counted. Zero liquidity value ascribed to municipal securities, as I described. And an asymmetric, is that 4 cylinders? Or 4 syllables? I may have just violated my rule. I can't use asymmetric. The unequal treatment of operational, including operational outflows, but not any inflows. Now, I was kind of relieved to hear that Mark Flannery can't find a serious study of this. I haven't found one. I found some that are online that seem to suggest that there really is no cost to excess liquidity being held by the banks. And as a practitioner, I can assure you that's just not the case. So I think in conclusion, I think we're on the right track. We have to have some liquidity regulation. It needs to be strong regulation. I think we may be heading down, what cul-de-sac were we in? The Lamarckian cul-de-sac. I'm just quoting him, those aren't my words. We may be in the Lamarckian cul-de-sac at the moment in some of these areas, and I think we have an opportunity to be on better track by addressing some of these issues. Thank you.
Thank you. Thank you to Brookings for having me and for the Clearinghouse for sponsoring this terrific event. I want to say at the outset, my remarks do not necessarily reflect those of Mark Vanderweide or JP Morgan Chase for that matter. What I wanted to do was just briefly review that a lot has been accomplished in this space, that more is being done. But in response to some remarks David Wessel gave us last night, talk about some things that I think should be considered, and then I think reiterate some of the points that Paul made, at least thematically, about there are implications. So a lot's been accomplished. Capital's doubled or more so over the last several years, and it's going higher. The CCAR process is firmly in place. And it is one that allows the Federal Reserve to leverage quite an extensive stress testing mechanism to ensure that banks' capital does go northward in direction, not southward. Leverage is sharply reduced in the system, probably by a third by many estimates, and that's welcome. Increased liquidity. I was hoping Charlie was still here. I don't see him, but he threw out a 20% number for his reserves at the Fed. Well, he may be interested to know that in the case of our firm, we have over $500 billion of high-quality liquid assets as defined in Basel, and that that's on a balance sheet of about $2.4 trillion, so roughly about has 20%. Capital and liquidity are both stressed. Internally, I think that's an important part of the supervisory toolkit to encourage banks to do internal stresses as well as the well-known external stress of CCAR. Many are probably not familiar, Mark, with CLAR, but that too is an important stress mechanism. It's evolving, but forcing banks to engage in a very structured liquidity stress exercise. So more is being done. Structural liquidity, Mark, you lamented a little bit about the 2018 implementation, for example, of NSFR, an important structural liquidity measure, but you'll be happy to know that many banks are already compliant or planning to get there a lot in advance, and that's a good thing. It's part of the overall toolkit, and it's in contemplation, but some type of debt shield in the context of orderly liquidation to facilitate single point of entry resolution is probably in the works, both domestically and globally, and that will aid us in the overall amount of resources that are available to facilitate a resolution of a financial institution should it get in trouble. Intraday credit in the tri-party repo market reduced by $1 trillion. We've imposed intraday limits here, and so this is also a welcome development. So we're becoming very fortress-like, we, the industry as a whole, and it's increasingly hard to see how banks won't be in a good position to deal with the next shock or severe stress. But more could be considered. So 5 examples of things that, Mark, you and others might want to think about if you're not already. You mentioned standardizing haircuts. That's something that we think would make sense. And I think there's already work. The FSB has done some work in that area, and that could be expanded. Introducing an interim tenor measure between 30 and 365 days. We do that internally, and Paul, I'm sensitive to the complexity concerns you have. These rules are complex, even though intended to be relatively simple. But an interim tenor might be something that bridges the concerns that you all have rightly about these types of gap risks. Increasing availability of repo clearing for liquid assets. That's done in the dealer community today, and work is being done to think about more extensive use of repo clearing, and that could be an important part of the overall mechanism for addressing concerns about short-term wholesale funding and fire sales. This one, I think, is an interesting one. It's something we do internally and should be considered more broadly, incorporating stress market capacity analysis and defining your liquidity profile. We do that. We think about what the potential is for being able to liquidate assets in stress and what that might mean, importantly, for our capital position, not just whether we could, there's market capacity to dump securities, but at what price and what might that mean for our capital. So in the previous panel, people talked about the importance of connecting liquidity and capital, and we think that's one way to do it. I will share an observation that Paul had, which is the U.S. proposal for LCR really takes this to a one-day giant stress, the way it's structured. And you have to ask the question, gee, could you really liquefy your, as much as you might have a big stock of high-quality liquid assets, could you really liquefy it if the measure is really one-day stress? And that ties into the market capacity issue. And I think the answer is probably no, so we have to really think about that. And finally, ensuring appropriate policies and requirements apply to all significant market participants, not just bank holding companies, we think is an important part of this. All of this comes with implications, of course, and I just wanted to mention a couple, and Paul has rightly mentioned a few as well. Beware the drawbridge. We now have the concept of a bad deposit. It's not something we used to think about before, but given the definition in the LCR in particular, distinguishing between operational and non-operational deposits, we now have a bad deposit called a non-operational deposits, and banks won't want to take those. They certainly won't want to take them, especially in stress times, and it raises the question, can banks be a safe haven in the next crisis? And it also raises the question, well, where will these deposits go? Will they go to money market funds, for example, because they're meant to be short-term? But as the SEC is considering changes to money market fund rules, what about potential gates and all of that, and how will these things intersect? And by the way, funds need to be shorter under SEC rules these days, while financial institutions need to be longer, so we're not issuing the paper that they would want to buy. So what will they buy with these short-term deposits? So important questions to consider. How will the leverage ratio and the liquidity requirements interact? Bank-provided liquidity backstops become very unattractive in the new regime. Will banks be less committed? We provide committed lines of credit, but will we be less committed? Paul mentioned municipalities, CP issuers, definitely adversely affected. The pricing, in conclusion, the pricing structure and availability of products and services will change, which might require important adjustments by wholesale consumers of our products and services. And we may be okay with this, the collective we, but as other panelists have observed, Mark and Paul, we're not sure this has been studied in its entirety. So a lot of important changes. We've improved the resiliency of the system. More is on the way. More could be considered, but we should try to understand the implications insofar as we can. Thank you.
Okay, thank you all. So let's just get ourselves mic'd up here and we'll Q&A. So before we go to the audience, I just have a couple questions for the panelists from things that arose over the course of your various discussions. I do think one of the central points that we could probably all agree on is it would be useful to have a better cost-benefit analysis of these liquidity requirements than we have to this point. It's not that none have been done. The Basel Committee on Banking Supervision has done analyses of this as they put together the liquidity rules, but I think we'd all agree that there's a lot more that could be done. So I'd like to ask you about that. Two points. One, none of us have yet really addressed the point of what's the societal value of maturity transformation. I happen to personally think, as I think most people who follow banking do, that it's quite useful to take short-term money and turn it into something medium to long-term that can be used in the economy. But I've talked to serious economists in international organizations in the official sector who aren't sure there's all that much value in it. So I'd be curious about your views, how you think of it, and then what your thoughts are on the kind of cost-benefit analyses you've seen to date and what more might be done. So I'll give you a chance first, Mark.
Okay, I probably will skip that second question. It was a little too metaphysical for me, but I'll go on the first one on the cost-benefit analysis. Cost-benefit analysis is pretty hard to do, both on the cost side and the benefit side. We try to do what we can when we issue individual regulations to size the cost that those would impose on the banks that would be subject to them, the financial markets, and the economy more broadly. We try to quantify the benefits to the broader financial system of the rules. But both sides of the ledger are pretty difficult to quantify. We also try to take a look pretty carefully at the intersections from the different rules that we're imposing. We're obviously imposing lots of different kinds of rules on different sets of banks. We're trying to look at the potential positive and negative synergies between those rules that come out, and to measure those to the extent that we can, so that so that the interactions are also taken a look at pretty carefully. But these are difficult things to do. Part of the way that we attempt to quantify the cost side for all of these regulations, and this is done in Basel and is also done internally at the US agencies, is we do fairly extensive quantitative impact studies of the potential shortfalls that different banks would have to the new capital rules, to the LCR, to the NSFR, to the single counterparty credit limits that the Basel Committee just put out. So we do attempt to quantify the somewhat more quantifiable side of the ledger, which is the cost side versus the benefit side, through that work. We also spent quite a bit of time internally trying to figure out what would be the costs to the U.S. banks that are going to be subject to the LCR. There's lots of different ways to come into compliance with the LCR. You can term out your liabilities, you can hold more HQLA, you can cut your credit lines. But we did a bunch of work internally to attempt to assess how much cost it would impose on the current banks that would be subject to it. The benefit calculations are just pretty difficult to do. So the work there tends to be a little bit more qualitative. The Basel Committee, as you mentioned, did do an assessment a few years ago, tried to do kind of a pan-regulatory assessment of the capital rules, and at least the NSFR, if I remember correctly, part of the liquidity program, took a look at the impact of that, measured the cost and the benefits as well as they could through economic models, and decided that the new capital regime and the NSFR were well within the range of social welfare increasing. And in fact, you could add a couple more percentage points of capital on top of what we've done, and it would still be net beneficial, even more beneficial to the economy perhaps than what we've already done. It's one study. The numbers are hard to get super comfortable with because of all the uncertainties around it, but we do the best we can.
Okay. Anyone else?
Sure. I mean, I actually think Mark understated the challenge of doing the cost-benefit analysis. I remember when I was still part of the Basel Committee when these studies were being done, and even when you can measure, let's say, the direct sort of cost to comply, what you're seeing there is the commercial cost, sort of the private cost to comply with a regulation. And on the better days, the appreciation on the cost-benefit analysis is one of the social cost versus social benefit, right, where I think the measurement error, the measurement uncertainty is even greater. I know that I had a renewed appreciation of the challenge that the environmental economists went through, because I at a time when I was in a position to largely be arguing for policies that were promoting financial stability, I would much rather have been, if it was just a debate, on the side of the debate that said the immediate cost to economic growth outweighed the benefits of financial stability, because it's easier to observe, it's easier to project the immediate cost than the uncertain and hopefully unlikely benefit of promoting financial stability. So I think that as we think about how to understand better the costs and benefits of, it's not as simple as just saying, well, we need to do better cost-benefit studies, but really to, if we can, deepen almost at a tactical level, what are the impacts of what's happening, and then make what is admittedly a judgment, a shared judgment, of whether those are the right outcomes to, a few of you have heard me use the phrase, the intended outcomes versus the unintended. There's going to be, and David made this point last night, there's a set of intended outcomes. If we understand those, we can decide, are the predicted outcomes within the intended class or in the unintended, and ones that we'd say in a judgmental assessment of the social cost, social benefit, are not the ones we want to pursue. Adam?
Yeah, just a couple of comments. I think it would be helpful in the policymaking process to, insofar as possible, be upfront about what those intended consequences are, because sometimes you only find out after going in and reviewing the proposal and trying to assess what the impact might be and providing that feedback, and they said, well, that's what we really wanted, but it's not obvious in all cases that that's the case. So it's not clear to me, and I again, align myself with Paul on the issues around munis. Is it clear that we want to have some effects on the way municipalities manage their deposits or issue their debt? And so I don't know, maybe that was an intended effect. The other thing, in fairness to the supervisory community, it's very hard to know up front what the response function of the banks will actually be. And so that's a very difficult position for them to be in. And it's the sequencing of the process that makes it so hard. The supervisors come up with a proposal, they issue it, we get it, we try to analyze it, we talk to our business folks and finance and risk folks and try to assess what the impacts might be, and then we project back to the supervisors what those impacts could be. But we haven't yet taken the actions, that we haven't really thought through alternatives, et cetera. So we don't know whether there'll be alternative providers in the marketplace such that there will be a net zero effect on municipal issuers. So that's all very hard to do. And Mark, you struck a chord with me earlier when you said we have to be thinking going forward in a way that lets us evaluate what the impacts are and make adjustments as necessary if we don't get it right up front. That we want to believe as bankers that is really an evergreen process and is easy to do. But I think some of the comments Paul made and some of the observations I've shared with you, it's hard once the policy gets fixed to change it sometimes. And so I think loosening up the reins on that might make it easier for us to adjust if we can't readily predict up front what all the impacts would be.
I'm not going to let you off the hook quite that easily. Since you do sit at a major bank, and I'll ask you as well, Paul, what do you think the impacts are going to be? How are banks going to be reacting to this set of changes?
Right. So we will change product structure, pricing, and availability on certain products.
And what are the major areas where you see that having a real impact?
I think certainly in the area of lines of credit, liquidity backstops in this context. There are other impacts from the capital rules and so forth that are confined to liquidity. There's no doubt that because the rules take a harsh view of liquidity backstops, for example. And so if you're a CP issuer or you're another financial institution looking for liquidity from a G-SIFI, that's going to be much harder to come by going forward. It will either not be available or be priced radically different. That may be an intended consequence, and it won't surprise me to hear Mark say that's an intended consequence, but that's definitely true. There will be adjustments required by the consumers of those products. So I think that's absolutely an area where Deposits is another area where I think you will see a big change. Deposits may end up getting termed out. They may get eschewed. We'll have to see. But if I were a corporate treasurer, I'd be thinking a lot about what these rules mean for me and trying to talk to my bankers about how things will change.
Paul?
Yeah, so let me go back to the cost-benefit analysis. I think we need to spend more time on that. I think that gets short shrift in the process, and I think it's subject to the kind of a super equivalent mentality where I think the agencies may put things out there that are intentionally conservative or have intentional impacts that aren't explicitly communicated. I think it would benefit the dialogue as a whole to be more explicit about that. Because then we won't waste our breath if that's an expressed intent kind of thing. The other thing, though, on industry, industry needs to tone down its super equivalency too. So every regulation, industry's first response can't be the world's going to end. And that frequently is the case. And so while it's easy to sit up here and say, I think a conscious decision to spend more time on the evaluation as opposed to the implementation would be a very useful thing. As far as the impacts, look, it's pretty simple. Adam summed it up. We're going to keep more cash on the sheet, period. And some of the changes are going to be really beneficial. As a practitioner, a lot of the contingent liquidity instruments that were issued probably never should have been issued in the crisis. And so I think that keeping cash, either prohibiting those or keeping cash sufficient to satisfy those should they be drawn, I think is a good thing. On the other hand, it is going to increase kind of the cost of credit and the cost of risk-taking because if you just take the simple balance sheet, you have less of the deposits to deploy. And you're going to end up with more cash, which is a drag on returns. And so far, we have not seen the capital markets drop their returns anywhere near commensurate with the increase in equity requirement. So, the idea might be, well, we're making banks safer, and the return requirements should decline, and there'll be an equilibrium. So far, we haven't seen that, right? We've seen equity requirements go up, which has the impact of obviously reducing return on equity, but risk premium for equity has not gone down by anywhere near the amount that equity requirements have gone up. So I think that's a problem. It hasn't sorted itself in 4 or 5 years. And so I think the outcome of that is probably an increase in pricing and more expensive or less available credit.
Could I pick up on one comment that Adam made earlier about back to the cost-benefit analysis? One way that we try to improve our cost-benefit analysis is to put proposals out for comment. The Basel Committee does it, the industry comments, the public comments, and then the U.S. implementation also always involves at least one round of public comments. So that helps a little bit, I think. But I think there is this fundamental point that Adam made that some of these regulations, it is hard to predict exactly how the banks that are subject to them or the financial markets more broadly are going to react. So you need to kind of watch and learn. And I think there's at least some good signs on the liquidity regulations that the regulatory community is willing to watch and learn and change. We put out the LCR in final form in 2010, made it effective 2015, I think was the original effective date. We amended it in material ways 2 years later, 2.5 years later, before the thing even went into effect, due to additional learning, additional conversations we had with the industry and the public at large. So I think on the liquidity regulations, we've recognized and need to continue to recognize that this is stuff that's new, and we need to be very attentive to potential unintended consequences, and I think we have been, and we will continue to do that.
Okay, now I notice none of you have touched the broader question I asked, which is why should anybody who isn't in the industry care about these rules in the sense of, is there a real value to maturity transformation for society as a whole? Is it good that there are people who want to put deposits and know they could get it back any time, and yet we also want to use that money for medium to longer term projects? And could you just give me some sense of how you think about that, or is this something you're just not focused on? Anyone? It does tell me something, and I've run into this before, and it does worry me. Now, I will say, for the benefit of the audience, almost everybody who's focused on financial regulation thinks maturity transformation has significant value. The economists I talk to who seem more skeptical generally have not focused on the area. But the fact that there are that I can ask this question and people are reluctant to answer is a concern. It makes the cost-benefit analyses harder, too, obviously, if you're not quite sure what the benefit is to society in the first place.
Well, I'll try a Main Street view, right? So I'm sure I may get some eye rolls from the academics here. But look, when we lend to a customer, so we are primarily a commercial bank, all right? So we take deposits. Our customers have a clear preference in the way they choose the deposits that we have available to them for liquidity, right? So the customers are expressing a preference for liquidity, no doubt about that. Certainly commercial customers are that way, and retail customers are as well. On the other hand, on the asset side, when you're lending to small businesses and they want to build a building that may have a useful life of 20 years, they want to have financing that is going to be predictable for that 20 years. And so I see it played out every day in the choices that our customers make, both on the asset and the liability side. Now, theoretically, can I quantify that? Nope, but I can tell you that I see it in practice every day as we go about the business of gathering deposits and making loans.
Absolutely.
Well, I guess I'd add that the observation could be, Doug, in the fact that the banking industry, though prone to paroxysms of a lot of syllables, Paul, sorry. Despite the episodes we have, has contributed significantly to economic growth through time. And so the idea that we would transform savings into productive credit and assets that support economic growth, I think has been validated over and over again. No doubt in the United States we've developed capital market functions that are a substitute for banking, and I think many parts of the world wish they had the capital markets that we do, notwithstanding some of their challenges. But the banking model has proved very successful in promoting economic growth, and I think that we should take that as validation point number one and deal with some of the issues that come up through the structure we've created to deal with the episodes we have where there's crisis of confidence through insolvency risk issues, et cetera. So.
Yeah. Well, it'd be good to continue the conversation later, but I'll just say briefly, I certainly believe that banking has been useful for society, despite the paroxysms. But there are multiple things banks do. They pool money together. They have informational value where they acquire customer relationships, et cetera. And they do maturity transformation, and I'm probably missing a couple other things they do. So the issue really is to figure out how much of the value is coming from the maturity transformation. I suspect quite a lot, but until we can nail that down more, it makes it all a little bit harder to talk about.
So, I mean, I think this was always the challenge in part of some of the cost-benefit analysis, because frequently the discussion would be phrased in not just the 0-1 question that you asked, is it valuable or not, but can we differentiate the good maturity transformation from the bad maturity transformation? Yeah. And what I can tell you from a policy design perspective, anytime then maybe this is to demonstrate that I'm a little bit of a chicken, but anytime that the debate was framed in those terms, that's the conversation I was trying to avoid. The conversation I think we tried to actively get in is the one that was framed the way you and Mark teed up the question, which is, if we know that there are two really core forms of externalities that are associated with liquidity, distress in liquidity in funding markets. One is the potential failure, and as Charlie was saying, it is related to a solvency question, but I think there's some challenges in trying to link the two, but it is related to there's just externalities associated with financial distress of an institution, and the other is the fire sale externalities. And so a lot of the design discussion turned into trying to understand the nature of what would make a financial institution more or less resilient. And so you could say implicitly as well, it had the effect of being this sort of evaluative or what are more and less valuable. But this is where something that was Mark said at the beginning. I would never would try never to describe the intent of the policy as reducing the amount of maturity transformation. I would frequently go with the intent of the policy was to address the externalities. It had the effect, in many cases, of putting pressure on what could be, for the purpose of this conversation, characterized as the less valuable maturity transformation.
And I think that's a reasonable way to view it. I guess one reason, and I'll turn to the audience in just one second, but the reason I keep coming back to this is perhaps it's been bad wording on the part of some of the regulators out there, but sometimes they seem to talk as if every form of maturity transformation was a bad thing. And I doubt that's what they seriously mean, but it does, again, create confusion. So let me turn to the audience, and again, to expand on David Wessel's ground rules, please identify yourself and your affiliation, as people have been doing, and you know the difference between a question and a comment, so try to make it a question. And Bert, you can't be the first guy every time, so Krishna?
Thank you. Krishna Guha, formerly with the New York Fed, now with ISI. I do think in the conversation one aspect emerged that I think is struck chord with me, which is I do think that regulators need to have a conservative bias because every other actor in the process has a bias in the other direction for very reasonable and rational purposes. So that itself doesn't trouble me. When we look at the question of short-term wholesale funding, I wanted a specific question. There's an expressed policy intention that Mark van der Weide referred to address this issue further going forward. There are a lot of different tools that could be used to do that, some of which you briefly commented on. I would be interested in the panel's assessment of what the sort of optimal mix of those tools would look like if we were tweaking different dials with the purpose of making further progress to reduce vulnerability to short-term wholesale funding runs.
I assume you're going to duck, Mark?
I'd love to duck. I'll just say some meaningless words, and then you can turn to these guys for something more intelligent. So I think the first effort that the global regulators took on short-term wholesale funding was really the LCR and the NSFR. So the first set of tools that we uncorked were bank liquidity regulations. I suspect that the primary reasons for that would include such things as tailoring the solution to the problem. If it's a liquidity risk problem, a liquidity regulation might be the most narrowly tailored solution to that problem. If it's a loss absorbency problem, maybe a capital rule is the right fix to the problem. So I think there's some tailoring benefit there. I think secondarily, there was a recognition that I think you could make a decent argument that the capital rule could address any possible risk we might see out there, at least in the banking system. But there is some reluctance, I think, for the global bank regulatory community to try to solve every problem with the capital rule. There's already a lot in the capital rule, and maybe we should have a little more of a policy of regulatory policy portfolio diversification and come at different problems with different sorts of tools. So I think that was part of it too. We've not been convinced that the LCR plus NSFR is enough of a solution to the problems in the short-term wholesale funding market, so we're exploring additional things we might do kind of in addition to that on the capital side, also on the margin side. One clear area where any kind of bank regulation doesn't fully solve the problem is when you've got short-term wholesale funding markets are not bank-specific. Banks are gigantically important players in those markets, but they go well beyond the banking system. Our regulatory tools tend to be fairly bank regulatory. There's a couple new tools you've got now to get at the market-wide phenomenon. You've got non-bank SIFI designations that the FSOC can uncork. If there's some single shadow bank out there that's looking pretty scary, they can go out and designate it. But again, that's only a little piece of the problem. There's also the problem of systemic herds of classes of individual firms, like money market mutual funds. There are a few market regulatory tools that we now have. One is the derivatives margin requirements that Dodd-Frank created. I think those are kind of part of the program. We've also had authority to impose margin requirements on securities financing transactions for many, many decades. The FSB is now currently looking at whether that should be part of the global financial response to the short-term wholesale funding, securities financing business. So I think we're kind of looking at all different tools at this point, trying to figure out what that right optimal balance is.
So, I mean, this is a point I made ineloquently before. I think that as we consider the remaining risks, I think there are two criteria that we could use in describe and thinking about what policies to pursue, which would be the exact wrong ones to use. The one would be, we have a hammer, so let's hit things. And so I know there's this temptation, and Mark, this is consistent with what you said, of capital regulations. Capital is great for solving everything. It is a very big and painful tax, and I guess my concern is that, and it certainly creates incentives, it runs the risk of not being the right tool for the right purpose, and so at the risk of violating Paul's concern and being characterized as someone who is pro-complexity, I would say I am pro-tailoring of rules to solve specific problems. The second is a pure sort of public, I don't even know how to describe it, a political science problem maybe, is, and this ties back to something Adam said, we should not be afraid to use tools that have otherwise been considered done. And I think there's a temptation in the policy debate to say, well, there are some things we have finished, and there are others that we are still working on, so let's use the ones we're working on to solve some set of problems. And in the same spirit of tailoring, I would say, in many cases, there's a right solution for the right well, whether you think if you have what you view as the right problem, then identify the right solution for that problem, even if it means sort of having to go back and break a few eggs and reopen policy that you otherwise considered complete.
Can I just address the conservative bias issue? I am with you that there ought to be a conservative bias. What I'm suggesting is that the unconsidered accumulation of a series of conservative decisions is what I'm concerned about, and it just needs to be explicit and considered.
Okay. Others? The woman in the back on this side.
Michelle Wilkins with the Export-Import Bank. I wanted to see if Paul Ackerman could expand on a comment that he made, that limitations of agency securities need to be changed. What in particular did you have in mind?
So there's a limit in the proposed rule. Agency securities are limited. There's a cap on the amount. They're known as level 2 securities, and there's a cap on the amount that can be included. So you've got these securities, and depending on your mix of other HQLA and level 1 assets, you can have a restriction that limits the amount of agency securities that are considered as liquid. And our assertion is that if you look at the market data and the performance of those securities during the crisis, they were indeed liquid. They were arguably as liquid as you can measure as many government securities. And so the limitation, we think, just isn't based on market data.
Our view, consistent with that, is if you don't want to get rid of it, if you don't want to eliminate a haircut, meaning treat them the same as Treasury, you can haircut the securities, but get rid of the cap.
Yeah.
Okay. Bert, why not?
Thank you. Bert Ely, Banking and Monetary Policy Consultant. This is a question, I think, primarily for Paul and Adam, and that has to do with, again, coming back to the issue of deposits. Deposits represent the largest single source of bank funding, particularly for domestic institutions. And I'd be interested in hearing more about how you see the LCR affecting banks' appetite for deposits, and what the impact of changes that are made by the banks subject to LCR in terms of their deposit gathering programs, what feedback effects that and spillover effects that's going to have to community banks, to banks not subject to the the LCR, or to put it another way, to what extent is this going to really cause distortions and unintended consequences in the deposit-taking market, which again represents the largest single source of funding of bank balance sheets? And then kind of a related question, is the LCR kind of a backdoor way of trying to impose the narrow banking concept on U.S. commercial banks?
You want
I'm going to go first.
So, Bert, I think you're right. Though this will affect bank, and I mentioned it in my opening remarks. This will affect banks' appetite for deposits, and we will work hard to distinguish what is considered operational versus not in the context of the rules, and we will have to adjust our offerings to reflect that. Now, what you might see is that banks change structure. So remember, the LCR is a 30-day measure. So perhaps you get what heretofore have been kind of demand-type deposits terming out. Mark might find that appealing, policymakers might find that appealing from a stability standpoint, but it does change the nature of the deposit for that corporate treasurer and so forth. So they will still be offered, but they might change in nature and they could change in price. But we haven't thought heretofore in such a semi-rigid way about what's a good deposit versus a bad deposit. Because if you have a bad deposit, you're going to have high-quality liquid assets held against it, and that means you're not going to be doing something else.
And by the way, just to be a little clearer, is this summary correct, that the the non-operational deposits we're talking about are corporate deposits which are not necessary to maintain a minimum balance for their sort of day-to-day activities,
Yes.
but are kind of voluntary
Broadly
deposits?
defined. That's
Yeah,
right.
fair enough.
I guess my response is I'm going to disagree a little bit with Adam. I don't think there are bad deposits. There are different kinds of deposits, and there are deposits that have different value, but I don't think there are bad deposits. So might I change my structure and pricing and the way I comport myself as a treasurer if I have a lot of non-operational deposits? Absolutely. And that will have to get baked into the way those deposits get priced and valued to the customer. But I don't think I'll just speak for us, it's not going to change our appetite to take deposits from customers because it is a valuable function. A corporate treasurer that needs a safe pair of hands for $200-300 million, even if it is not operational, that's still providing a service to them, and we'll figure out a way within kind of the regulations or reasonable liquidity management to provide that service to that customer. So I don't think it's going to change our impact. As far as large versus small, I don't know that there's going to be a huge disparate impact. I think there are reasons why some customers choose large banks, particularly in the corporate realm, because of the array of services that can be provided to them that simply aren't available in some of the smaller banks. So I'm not sure we're going to see a tremendous movement between the two because of differences in regulation.
Okay. And maybe the distinction Paul's making between our views, the nuance, and it has to do with the business model. We're a global bankers bank and a huge prime brokerage operation. So we're going to have a class of deposits that don't fare well under the LCR. And so, again, we're going to have to factor that into our thinking.
Okay, others? David?
David Schroff from the IAF. Very interesting discussion. I don't think anything has been said really, maybe indirectly a little bit by what Mark just said about effects of these liquidity regulations on market liquidity. It's maybe been a little bit alluded to by the two Marks in talking about short-term financing transactions. But certainly one of the things the industry is very concerned about is the potential impact of the NSFR as currently proposed on market liquidity for equities and all short-term markets. I wonder if you could comment a little bit on that.
I can comment a little bit. So this might be in reference to the recent proposal by the Basel Committee to put effectively a required stable funding factor or a haircut on some of the reverse repos that some of the large banks have. One of our fundamental ways in which we're not convinced that the LCR plus NSFR does all it needs to do to mitigate risks in short-term wholesale funding is because both the LCR and the NSFR are, until this recent proposal from the Basel Committee, were really completely blind to maturity-matched books of repo and sec-lend, sec-borrow. And while that might not be maturity transformation, it might be a maturity-matched book. It still feels like there's some pretty significant liquidity risks there, I think both from a microprudential and from a macroprudential purpose. From a microprudential perspective, it's not at all clear that we should expect the global bank that comes under liquidity stress to yank every single one of its reverse repos to all of its customers, platinum, gold, and silver. So I think there's some just natural selfish microprudential reasons why we probably shouldn't expect complete inflows of that kind of short-term lending by broker-dealers. And then also just from the macroprudential perspective, even if you've got overnight repos matched with overnight reverse repos on the other side, a quick unwind of that book, if it's large in particular, is going to have some pretty negative financial stability effects. So we felt like one thing that needs to be done to kind of ameliorate some of our STWF anxieties is to impose some kind of asymmetry, some kind of a regulatory charge on that matched book. The Basel Committee put out a proposal a few months ago that would impose a 50% required stable funding factor on some of those reverse repos, those short-term loans. A lot of negative feedback on that during the comment process, and the Basel Committee will be taking a look at that. That'll be one of the key issues that they'll be taking a look at as they move to a final NSFR later this year, and we will be actively engaged in that debate. It's been criticized as too high. It's been criticized as not risk sensitive enough. It's a 50% charge basically for all reverse repos, no matter what their term, no matter what the collateral is. So we'll be taking a look at whether more risk sensitivity, granularity is a good idea there. The provision also carved out banks, so the interbank markets were left kind of free and clear, and it was really kind of bank lending to hedge funds that got hit with the 50% charge. There was some criticism of that, picking of winners and losers in the repo markets. So that'll be an issue that we'll be looking at quite a bit as we move to refinalize the NSFR later this year.
This gets into the trade-offs or simplicity and complexity, right? Because we're certainly not allergic to having stable funding against these types of assets. But they need to be adjusted for credit quality and the type of asset it is. Well, that means you're going to have to get more granular with respect to the rules, and that runs across purposes with the simplicity argument. So there's a balance in there somewhere that'll have to be found.
Okay, other questions? Yeah, back there.
Thanks. Tara Rice, the Federal Reserve Board. And within the Fed, the two marks are near heroes. So we've been talking a lot about this from a domestic perspective.
I'm sorry, did you say near heroes?
They are heroes.
Oh, okay.
So we've been talking about this a lot from a domestic perspective, as we should. But I'm just curious, as we have differences with Basel III and how it's been interpreted internationally, I'm just wondering if anybody has opinions on what may be some of the major differences as we come to implementation again across countries. I know one of them could be the definition of HQLA. Wondering if you had any other thoughts.
So the Basel Committee has paid a lot of attention in the last couple of years to making sure, as they write all of these new different rules for global banks to comply with it, jurisdictions are actually implementing them faithfully, both in the letter of the law and also in the implementation of the law. So the Basel Committee has moved quite significantly, I think, from being just a rule writer to being I won't say a rule enforcer, but they definitely are spending a lot of time making sure that jurisdictions implement the rules faithfully. And I think the focus of the attention so far has been on the capital rules, and I think that's significantly because under the current Basel capital rules, there's a lot of discretion given to bank internal models and internal rating systems, which are obviously susceptible to quite different implementation by individual banks and individual regulators. So the Basel Committee's kind of been all over that issue in particular over the last couple of years. But they're also going to spend a lot of time trying to make sure that the liquidity rules and some of the other rules that have been adopted are implemented faithfully across jurisdictions. The way Basel agreements work, the way they've always worked, I expect and indeed hope they always will work, is that they are floors. So each jurisdiction is permitted under the Basel agreements to go super equivalent, as we like to call it. And each jurisdiction, some jurisdictions will do that. The United States has proposed to do that in some material ways. And we're still thinking about all those issues as the comments come in. The liquidity regulations, I think, Mark might have a different view or might have the same view, but I'll be interested in hearing his view as well. One of the challenges of producing a globally applicable liquidity rule was the very significant differences in funding markets across the world. To me, at least, it seemed conceptually easier to make a capital rule apply to all global banks, more difficult because of the heterogeneity of funding markets around the world to come up with a liquidity rule that worked kind of for all global banks, all markets. But we did the best we could, and the Basel Committee will make sure that that floor is is complied with by all the jurisdictions around the world.
So I think the other challenge, I'm not convinced it's that much harder. Well, let me rephrase it. I'm not convinced it's that much easier to get a globally consistent capital rule because I think the asset markets, when you get to things like the standardized approach, thinking that the risk of a mortgage is comparable in different jurisdictions.
Yeah, they're both pretty hard.
Is a pretty generous step. But I think the challenge that is incrementally hard for liquidity is that there are few boundaries to institutions operating in multiple funding markets. And so I think it is of great importance that the committee actually find a way to promote consistency in the implementation of liquidity regulation. I think there's some operational observations that, as Paul said, the reporting burdens are high. I'm not sure if that's an unintended or that their burden is high.
Super high.
Super high. Okay, I'll go with super high.
Go with super equivalent.
And then when you get differences across jurisdictions, it has a increment to that because having sat in a conversation once with another agency, we'll leave out which agency it was, and the intent was for two agencies across borders to agree on common liquidity reporting. Everyone agreed it was the most important thing they could do, and the conversation started with, but you, of course, will agree to go with the reporting that we just put out in regulation. And the conversation, as you would imagine, didn't progress terribly well after that. So I think that there are high costs to not getting consistency from an operational end. The other is there are high costs, given the sort of flexibility in funding arrangements, there are very high costs if firms are not subject to consistent regulation, that they can, even with the FBO rule, you will see foreign banks can fund themselves in U.S. markets, and if they're not being subject to comparable regulation, we'll get very different funding dynamics between the domestic and foreign organizations.
Another problem with manufacturing a global liquidity rule was one of the key issues that we had to debate with and have debated and will continue to debate is how to make those rules interact with the central bank lender of last resort facility. And different central banks around the world have very different policies around how they do a monetary policy, how they do lender of last resort. And that was another challenge kind of to produce a globally common template for a liquidity rule.
Yeah, you had a question, Martin?
I'm trying to make sure this is not too amorphous, and maybe I'm pushing on the same string that Doug was putting on in terms of maturity transformation. But how much intermediation do you think should go through banks in our economy? We have a certain level of deposits. Deposits historically were quite unstable, and so we had deposit insurance, and we made that unstable liability to be quite stable. So now banks can lend against that, and they can lend long even though they're borrowing short. So that didn't seem to be enough money, so they went out and started looking for wholesale funding. They're getting money from money market mutual funds or that sort of deposits also that are cycled through the money market mutual funds. So I'm a little surprised that the bankers here are so sanguine about these changes. You can't use these forms of funding that are not stable. We're not going to lend you liquidity as a lender of last resort except under extreme circumstances. So I'm just wondering, where's the money going to come from to provide bank-intermediated loans that are so important for companies, small companies, and so on. And is that, when you were making these regulations, did you do any kind of adding up and sort of say, okay, here's the amount of saving, here's the amount of deposits, here's the amount of intermediation? Is that going to be enough to finance growth? Or did you just say, we don't care, we're just going to make it safe?
So let me start.
Of course, they said we don't care.
Yeah. Yeah, secretly the conversation was we didn't care. No, try to be serious. I think that there was an appreciation that you didn't want the safety at any cost, and that you wanted to not promote, wrong word, to not interfere with stable maturity transformation. And so that's why, notwithstanding some of the comments earlier today, and even the questions about the deposits now, the LCR, for example, intentionally differentiates among types of deposits. So there is a strong recognition, I would say, maybe not a perfect recognition, because there is still an assumed outflow of insured deposits, but there is a strong recognition of the benefits of deposit insurance. And so the incremental cost from liquidity regulation on that form of absent deposit insurance, but with deposit insurance, stable maturity transformation is not what the intended and unintended discussion is not what the LCR was intending not to tax that type of maturity transformation. I think the hard part is then when you get to everything else, And I think there were two, in the discussions then, there were sort of two ways one could have gone about this. One is to come to a view of sizing the right amount of maturity transformation, which had all of, I think, the cost-benefit, social cost-benefit challenges we described before, or to come to a view about there are significant costs of financial distress. The big takeaway for a lot of us from 2000 to 2007 to 2009 is that we may have underestimated the cost of financial distress, at least within regulated institutions and maybe more broadly. And so I don't think we should be surprised that coming out of that, and maybe to David's point from last night, there's been an overreaction. But I don't think we should be surprised that there was an intent to move the lever and say on the trade-off of transformation versus financial stability, the pre-2000 point on that trade-off, not where we want to be. Pretty clear which direction we need to go. And then to everyone's point, I think there's a good debate about, over time, how do we determine if we've gone far enough, just right. The odds of it getting just right are, I'll go for 0, but either not far enough or too far, and then have the willingness to be somewhat flexible over time. I do think there will be a market mechanism that provides some relief. I don't say this critically, but banks are very good at appropriately arbitraging the rules that exist in a way that allows the risk and the return to come into appropriate line. In some cases, there is less appropriate arbitrage. Some of that is from exiting the banks to the shadow banking, and that's why I share Mark's view that there has to be a discussion, and that was teed up this morning, about what are the incentives to move activities outside of the regulated sector. But I hope the reaction we get is not that, how do we get, and this was David's point from last night, how do we get back to where we were? This was a big, very painful experiment that said we needed to move the needle. And I think that was the overriding perspective as we were going through it.
Martin, you expressed surprise that bankers were kind of more opposed to the rules, and I think Paul and I have highlighted some of the issues that we have with the specifics. But by and large, these rules reflect how we think about liquidity, both from a stress and a structural standpoint. And in fact, the binding constraints may not be these particular rules, but actually will be our internal liquidity stresses and the external type of CLAR type stress measures. So this is not inconsistent with how we think about the risks, and the crisis taught a lot of important lessons, and I think there's been a significant adjustment in how banks, at least this one, how we manage liquidity in the post-crisis world.
Just want to add on to that. Back to the shadow banking point, these rules are going to apply to global banks, and they're likely only to apply to global banks. Lots of the scary forms of maturity transformation that occurred that caused firms to collapse back in 2007 and 2008 weren't part of firms that were subject to bank regulation. More of the financial sector right now currently is under the bank regulatory perimeter, but there's no guarantee that it will always remain that way. One thing that we definitely spent a lot of time thinking about as we constructed this liquidity regime was, are we going to just put this severe constriction on this relatively small set of large global banks and just see the activity flow right out of them to other firms that aren't? Right. And so we tried to do some things to make sure that we're not just pushing the risk elsewhere into the completely unregulated space, which may not be at all better. One, I think, important set of things that we did and spent quite a bit of time negotiating in the past few years was a lot of the shadow banks that did engage in a lot of the scariest forms of maturity transformation back in the crisis were only allowed to do that because they effectively had a bank sponsor or a bank liquidity provider or a bank credit enhancer. And so part of the changes to the Basel III capital rules, part of the provisions that were put into the LCR and the NSFR were to make it much more expensive for banks, at least, to sponsor a lot of those shadow banks that engaged in the scary maturity transformation activities. So in the world that we're creating, it does look like banks will be able to still engage in forms of maturity transformation, more stable forms. Shadow banks will still be able to engage in those sorts of activities too, but there's just going to be much greater constraints on banks. I'd say much greater constraints on really big banks, greater but maybe not much greater constraints on the medium-sized banks, and less constraints on the shadow banks, but we're pulling the levers that we can to make sure that there's not quite the same sort of Wild West activity going out in the shadow banking system too.
Okay, please join me in thanking the panel. We've come to the end of our time. So the next step here is you should eat. We've got a buffet lunch out there. You can eat it in here or nearby. Please be back in about 20 minutes, I think it is.
About 5:01.
Yeah, yeah, 5 minutes to 1. We have Undersecretary of Treasury Mary Miller will be speaking starting at about that time. Thank you all.